Welcome to The Explainer. Today, we're unpacking a genuinely fascinating phenomenon that just played out in the markets on May 18th. On the surface, it looked perfectly peaceful. But underneath, oh man, there was extreme volatility, completely masked by what was essentially a functionally flat index. So let's decode this illusion of calm together.
If you just quickly glanced at the closing bell numbers, he saw a tiny, microscopic gain of just 0.03% on the Nifty 50. Now, if you think that means it was a quiet, sleepy day on the trading floor, you'd be entirely wrong. Honestly, relying on this single number is probably one of the most dangerous things an investor could have done today.
And that brings us to the core mystery of this explainer. How exactly can a functionally flat market hide such extreme volatility? Like, what actually happens when you peel back that 0.03%? Well, let's dive into the data to see how this seemingly calm surface is actually masking a massive, chaotic tug-of-war beneath, where literally billions of dollars are violently switching sides.
Here's our roadmap to decode this bipolar market. We'll start with the illusion of market calm. Look at a tale of two divergent markets, examine the extreme selectivity of individual stocks, zoom out to the global macro storm driving all this, and finally, wrap up with the strategic investor takeaway. Let's get right into it.
Section 1. The Illusion of Market Calm. We're going to unpack the intraday movements that totally shatter the idea of a quiet market.
Just look at this incredible 378-point intraday roller coaster. The market was violently swinging up and down all day long before finally settling right near where it started. And hey, this wasn't happening in a vacuum. The liquidity was robust. We saw a staggering 1.23 lakh crore rupees in traded value across more than 41 million trades. That is massive participation. Make no mistake, this is the definition of a highly active, highly contested market.
To add to that, if we look at the India VIX, it rose sharply by 0.84 points to hit 19.63. Now, a rising VIX combined with a flat index, that tells us one thing for sure. Tension is building up, not dissipating. Moving on to Section 2, a tale of two markets. Let's look at the deep sectoral split to see exactly who is pulling the rope in this incredible tug-of-war.
It was a deeply divided day. On one side, you had the clear winners, technology and pharmaceuticals leading a massive bullish charge. But on the other side, you had traditional heavyweights acting as a massive anchor, just dragging the market down. We're talking energy, banking, and metals. The market absolutely did not move as one cohesive unit. It basically split right down the middle.
This contrast perfectly illustrates the divergence. While the broader Nifty 50 intraday chart managed to stage a recovery and somehow end in the green, the Bank Nifty clearly struggled. It faced a notable dip and just completely failed to catch that upward momentum. This really highlights the actual pain sitting inside the financial sector right now, which is completely disconnected from the broader index's recovery.
When you put the point changes side by side, the contrast is just incredibly stark. The Nifty IT sector soared by nearly 673 points, driven heavily by international demand and positive corporate earnings sentiment. Meanwhile, Nifty Energy plummeted by almost 300 points, and the Bank Nifty dropped by over 173 points. And honestly, this is exactly why the market ended flat. The explosive tech rally was perfectly neutralized by heavy profit-taking in energy and banking. It's a total stalemate.
Section 3. Extreme Selectivity and Divergence. Let's see how this massive divergence played out across individual stock outcomes.
Taking a look at the top securities in the Nifty 50, you see this exact divergence playing out in real time. Telecom and healthcare leaders like Bharti Airtel and Sun Pharma, they're up, and that signals a lot of confidence in the digital economy and domestic consumption. But look across the aisle. Commodity and industrial giants like Tata Steel and Power Grid took significant hits of over 3%. Basically, investors are selectively picking high-conviction growth stocks while actively dumping those cyclically sensitive heavyweights.
But you know what's really fascinating? The polarity gets even crazier outside the megacaps. In the mid-cap and momentum space, it was a totally wild ride. Pharmaceutical stock GLAN skyrocketed over 15% in a single day, which suggests massive institutional interest. Yet, on that exact same day, consumer electronics stock Amber crashed by exactly as much, down 15.61%. I mean, this is bipolar momentum at its absolute finest.
To truly understand why these traditional indices are struggling while tech thrives, we have to look outside of India. Welcome to Section 4, the global macro storm. Right now, India's domestic resilience is battling a really severe storm. You've got strong retail participation and domestic revenue growth trying to stand tall against what is essentially a massive tornado of international macroeconomic headwinds.
And the global threats making up this storm? They are mounting fast. First up, sticky inflation has pushed German 10-year bond yields to a 15-year high, basically signaling a global bond rout. Second, ongoing Middle East conflicts are sparking some really significant oil price spikes. Third, because of these global rates, foreign institutional investors, or FIIs, are fleeing, trimming their holdings in some mid-cap stocks by up to 50%. And finally, all this elevated oil pricing and weak capital flow has economists forecasting a massive $65 billion balance of payments deficit for India. That puts a severe strain on the rupee.
So when you combine rising global bond yields with oil spikes and a straining currency, well, it's really no wonder Moody's Ratings issued a stark warning today. They pointed out that corporate earnings growth is expected to materially slow down over the next 12 to 18 months. Rising input costs, supply chain disruptions, these are exactly why we saw traditional industrial and energy stocks act as such heavy anchors on the market today.
Now, despite all these dark clouds globally, there is a silver lining, a domestic buffer. SEBI chief Tuhin Kantapande noted that retail investor numbers have surged significantly within India. This domestic capital is providing a really crucial cushion against that fleeing foreign investment. But he also cautioned that while awareness is definitely up, disciplined, long-term investing is absolutely essential right now to navigate this complex environment.
Which brings us to our final section. Section 5, the strategic investor takeaway. We've seen the divergence, we've seen the global storm. So what's the actual actionable insight for your portfolio? The most crucial point to take away from all this data is simply this: you must adopt a selectivity over breadth approach. Buying the whole haystack just isn't going to work when half the haystack is on fire, right? You need to focus exclusively on companies with robust, defensible fundamentals that can actually withstand a global liquidity squeeze. Avoid sectors that rely on cheap, easy global capital, and keep a very close eye on domestic monetary and fiscal policy because that's going to be India's primary buffer against these external shocks.
You really have to choose your battles wisely right now. Smart investors are actively leaning into the bullish momentum of growth in defensive sectors. Think tech, telecoms, domestic healthcare, while actively sidestepping the bearish, cautious sentiment surrounding commodities and heavy industrials. Basically, it's a market of micro-narratives right now, not sweeping macro trends.
Which leaves us with one incredibly crucial question to ask yourself as you review your own investments. In a functionally flat market that is actively hiding massive extremes and a vicious tug-of-war right beneath the surface, are you betting blindly on the broader index, or are you strategically targeting the hidden momentum? Thanks for joining me on this explainer. Keep your eyes on the data and stay sharply focused out there.